Hey everyone, it's me, Corrie Sommers, your local Los Angeles luxury realtor. Today we're going to be talking about 12 hacks to pay off your mortgage quickly. You're not going to want to miss this. Some of this is new information that you've never thought of, and trust me, you're going to want to apply this to your mortgage. Hey everyone, it's me, Corrie Sommers, your local Los Angeles luxury realtor. Today we're going to be talking about 12 hacks to pay off your mortgage quickly. Banks are in the business of making money. Yes, that's right. They let you loan out money so that they can make money. It's all about interest payments. Many people don't remember when we were taught about banking and government, 5th grade. Banking institutions are a fractional system. They only keep about 10% of the deposits in-house, and they're taking your money, your deposits, and making money off it. So lending out money is one of the many ways that they make money. They make money in interest payments. So they have a strong interest in getting interest. That said, most people don't realize when it comes to your mortgage loan, it's done on an APR interest rate. And that interest rate is actually amortized over 30 years. But the way they amortize it, you're paying the interest at the beginning portion of the loan and your principal towards the ending portion of the loan. So you might say, what exactly does that mean? So we're going to use some raw number examples. Let's say you're buying a home for $1 million. You're putting 10% down and you're financing $900,000. Your interest rate is 3.8. The interest you will pay over the 30 years term of that loan is about $609,000. That's why most people realize when you buy a home, you're paying for the home like a home and a half because of interest. But that is nothing to be scared of, because today I'm going to share with you 12 hacks to paying off your mortgage quicker, and it will save you a ton of money when it comes to interest. And why am I qualified to talk about this, you might ask? Well, I do have a background in finance. I started off as a loan officer. I've worked for a financial planning office, for a financial planner's office. And I also have a license for insured financial products. That is definitely my background, is finance. That said, any of my clients that work with me, when we close, I give one of these tips, which I feel is the strongest and most easy to follow, as well as a calculator to help you really maximize this as well. So for everyone watching, stay to the very end, because I got some little giveaways for you too. All right, so we're going to go into strategy number 1. Now, this strategy is the first strategy because I think for the majority of people, it's one of the easiest ones to follow. And that is paying your mortgage every 2 weeks. Now, when I say it's one of the easiest ones to follow, it's easy in terms of you can write a check every 2 weeks for your mortgage. Meaning, let's say your mortgage is $2,000 a month. You're going to write a check every 2 weeks for $1,000. I say check because many loan servicing companies, while they have great websites that you can pay online, they don't allow you to pay less than the minimum mortgage payment note. So for those ones, this won't work. You'll have to do this by check. So what you do is the first check that you send in, you have your account number, you say mortgage payment. The second check that you send in, you have your account number, you say mortgage payment plus principal. And that way they'll apply that to the principal. By doing this every 2 weeks and being in the habit of doing this every 2 weeks, you will get a full extra payment a year. Plus the fact that you're paying it every 2 weeks is actually paying against the interest quicker at a rapid rate. And so this is the reason why this is the very first strategy. Strategy number 2 is the thing that I share most often with my clients. I began sharing this when I actually worked in the mortgage industry. If you make 2 extra payments a year, you will shave down the term of your loan from a 30-year fix to about 15 to 17 years. Now, you might ask, how do you do this? The best way, if you have a job that you're paid every 2 weeks, is this. Twice a year, you receive a third paycheck. It is typically in May and in August. Before you do anything else with that check, make the extra mortgage payment and then use the rest to get you through to your next paycheck cycle. If you have a good budget in place, this will be relatively easy to do, and this will shave down the term of your loan very quickly. Strategy number 3 kind of builds off strategy number 2, which is still making 2 extra payments a year, but this time, let's say you are an entrepreneur, you are self-employed, you're commission-based, so your income is just not consistent. still take a look at what that mortgage note would be. Let's just use round numbers. Let's say your mortgage payment is $2,000 a month. So 2 extra payments a year is for $4,000. Divide that by 12 and make that extra payment every single month. You will chunk down the term of your mortgage. I'm actually doing this myself. I a couple of years ago refinanced my condo to pull out some money to flip some homes, and then got new tenants, had to fix up the place, yada, yada, yada. Point is, I sat down and figured, okay, what is the 2 extra payments a year? And then I looked at how much I was cash flowing on the new tenants. So instead of putting any money in my pocket, I am taking the 2 extra payments plus a little bit more, and I'm paying that down every single month. And my condo will be paid off in 10 to 12 years. So I'm very excited because that's a part of my retirement. And something like that, your first home purchase, whether it was a condo or a small home that you've held onto, we have to look at these assets as being a part of our retirement. So the quicker you can pay it off, the quicker it cash flows, the quicker you are building wealth. The fourth strategy is simply don't take out a large mortgage. Now, you might say, okay, this is stupid. We're in Southern California. Where can I get a home that will meet my family's needs for under $2 million? I get that. That's not what I'm saying. I'm saying as you get older, we tend to step up in our homes based on needs and the growing needs of our family or our accomplishments, which is fantastic. We all should eventually have our dream home, right? But at some point, your home is more than you need. It's more space. The kids have left. They're in college. They've moved out. They've gotten married, etc. Do you really need 5 bedrooms anymore? Can you scale down to a 3-bedroom? Now, I never recommend something smaller than a 3-bedroom because they do have the best resale value. But can it be just you and your spouse and then a room for guests and then the office or theater room or whatever? Can you scale that down? Reason being, the smaller your mortgage, the less you have to pay, the quicker you can get it paid off. If you are retiring, or maybe because of the pandemic, you're now working from home, do you need to stay in Southern California? Can you take and sell your home and take that profit and live in a state where your money can go further in the purchase of a home? Or, like I just said, you're about to retire. What about a state where your Social Security and your retirement isn't taxed? There's reasons that people flock to various states when it comes to retirement. Don't worry, I have a whole video series coming on that. We're not going to dive too deeply into that. But again, I'm just saying, think a little bit when you're making your home purchase. That's all I'm saying here. The larger the mortgage, the longer it takes to pay off. So the fifth strategy to paying off your mortgage is this. Anytime you come into a lump sum of money, apply it to your mortgage. Maybe it's a tax refund. Maybe it's an inheritance. Maybe it's a life insurance payout. Your grandparents died. They had a policy. There were 5 of you on the policy and you're getting an extra $5,000. Put that on your mortgage. Maybe there's some refunds coming in from overpaying on your insurance, or the last time you did a home refi, or anything like that that you just weren't expecting and counting on in your actual budget. Pay that down on your mortgage. You will be grateful for this later. Strategy number 6 is about increasing your income. Now, if you're working a job, typically you're going to get raises. If you can keep your budget and your expenditures at what they are and don't increase that, but your income increases, you can use that overage to pay more on your mortgage. The other thing is bring in other revenue streams. There's so many programs out there that allow you to work a business on the side. Maybe you're passionate about vitamins and minerals and you do Herbalife, and well, why not sell it? Maybe you are passionately, like your hobby is creating gift boxes or flower arrangements. Turn that into a business. Whatever that you have a natural talent and ability for, turn that into revenue. Maybe you used to be a journalist, but now you work a corporate job. There's places you can go to do freelance work. Turn what skills and tools you have available right now into side revenue. The 7th strategy to paying off your mortgage early is using your actual property to generate more income. How, you might ask? Well, of course, with Airbnb, you have some options there. You could Airbnb out your place when you go on vacation. You could Airbnb out your place or a room consistently, or Airbnb out the top floor. There's ways to work around that, right? But then there's also other creative ways. Put a shed on your property and rent that out as storage space. Or if you have a property that has that long driveway for the RV or boats, Put it up for rent and get someone to park their RV and their boat on your property. Charge them monthly rent. Bring in some additional income. And the beautiful thing here in Southern California is the whole ADU law that's passed. You can convert your garage into an ADU or build an ADU and take that profit and pay that down on your mortgage every month. There's a plethora of ways. You just have to think a little more creatively. Maybe you have a beautiful home and this is your dream home. So you're like, I do not want to Airbnb it out. I don't want to put an ADU. I don't want people here all the time. Well, there's Peer Space. You can rent out your place for content backdrops. You could get in, people that shoot videos are looking for that all the time. Great locations, even for shooting film, television. You can get in that circle and make some money on your property. In fact, those pay very well. The one thing about that I will bring up, and I want you to make sure you do, if you go that direction, is you want to make sure that in that agreement you have a cleaning fee, that they must restore your home to the exact condition it was before they came in. Because in situations like that, there will be a lot of people traipsing through an equipment and it can scratch floors. It can really leave a lot of dirt behind. So just make sure that you think in advance and get that a part of that agreement. Strategy number 8, reduce your expenses. Now you might be saying, okay, how? Well, let's take a look at your expenditures. Do you have a bunch of subscription services? Do you have Hulu, HBO, Cinemax, Stars, Netflix? Do you need all of those? Get rid of them. Go back to cable. Yeah, I said it. Unless, of course, getting rid of cable and going to one streaming service is the better fit. Look into that. What about the money that you're spending on coffee every day? Do you need to drink coffee every day at a coffee shop? Can you cut that back? Can you make coffee at home? What about eating out? Do you eat out every single day? Can you trim that down to once a week? Or do you eat out once a week? Can you trim that down to once a month? Look at where you're spending money and trim some of those things back. It'll free up some cash, then take that cash and pay that down on your mortgage. This 9th strategy I'm actually kind of excited about because I'm starting to do it myself. My sister's a CPA and we had a long talk about how you pay your bills online because I do everything that I can do online. But when you're using your debit card or a check online, the ACH, they're not as secured as paying with a credit card. So every monthly reoccurring bill that you can pay online, pay it online. Your cell phone bill, your cable bill, your car insurance, your health insurance, if you can pay your electricity, everything that you can pay online with your credit card and then pay your credit card off. So I'm not saying start using your credit card excessively. You stick to your monthly payments, stick to your budget, but just change how you're doing it. So the day you make those payments, pay with your credit card and then turn around and pay your credit card right off. Do it all the same day at the same time. It'll take care of itself. Now, it's about using the right credit card because most credit cards today have rewards programs. And I always look into that because there's a credit card that I get free gift cards to go shopping and to do this, that. But the best credit card and the one to use this method with is the one that has cashback rewards. And if you don't currently have one of those, look into that. Because by paying your bills with the credit card with cashback rewards, you will earn cash. So let's just say your bills are $4,000 a month. You're going to earn a couple $100. Take that couple $100 after you've paid down the card and apply that to the principal of your mortgage. You have just increased your money by a couple $100 and you're paying down your mortgage. This is definitely one to really, really apply. What is the 10th strategy to paying down your mortgage quickly? It's creating a budget and sticking to it. Yeah, I said that. Budgets are so very important. And this is one thing that I will say my dad taught me at 17. He sat me down, showed me how to make a budget. He was like a little tech whiz. So he did it with Excel and, showed me how I could actually create it. And what was so interesting is he really allocated everything he spent money on. Money going out to eat, his weed money, gas, food, bills, everything you can think of was in this budget. He knew where his money was going and how much he was spending. And he definitely sacrificed for the things that were important. But it taught me about budgeting, and budgeting is so important. And so many people today don't have a budget that they check in with. And if you don't, stay to the end. You can reach out to me. I will send you a budget to use. And some of you might say, well, what qualifies you? For those that don't remember, I did I do have a background in finance. Not only went to college for finance, but worked at a financial planner's firm, started off in real estate, working for a mortgage company. And there's just some things that we really are not taught that we need to apply to our life if we are going to be both financially responsible, create wealth, retire at the same standard of living, and hopefully create generational wealth. But that's a whole nother topic, and there's a course coming. Yes, very excited about that. But that said, just having a budget in and of itself and sticking to it and looking at where your money is going will help you to see where you can actually trim down some things. So let's give a great example. Going out to the movies. Yes, I know we've been really restricted, but it's coming back and more people are starting to do that again. Think about this. If you're a family of four, movie prices have gone way up. And I mean, now to be fair, most of the movies have been retrofitted and they've got the nice reclining seats and it's a much better experience. But movie tickets are like $17.50 to $22, or in some places even more. AMC has a program, their Stubs program, their A-list, where you can pay a monthly fee. I think it's like $22.95 and see up to 3 movies a week. So if you're a family of four, let's round these numbers down just a little bit. You can either spend $80 a week taking your family out to the movies because you go out to the movies once a week, or instead of paying $320 a month, you can pay $80 a month on the rewards program and still see the same number of movies. And you know what I'm going to say next. The difference between $320 and $80, apply that to your mortgage. You have just found money. Look what a budget can do for you. Strategy number 11 has everything to do with PMI. Now, what is PMI? You might ask that or say, I've heard that before. I don't remember what that is. PMI is the insurance that lenders apply to your loan. It is the private mortgage insurance. So if you are buying a home and you're coming in with less than 20%, all lenders will apply PMI. This is for 2 reasons. One, they want to protect themselves in the event that you default from your loan. It's also a way for them to make money. So PMI, let's just use the previous example. You're buying a home for $1 million, 10% down, $900,000. Your monthly PMI is $375. That's $375 on top of your mortgage payment, your insurance, and taxes. So it's really important to pay attention to when you get to 80% value paid down on your loan against that purchase price. So what does that mean? If the purchase price was $1 million, that you're down to $800,000, you can have your lender drop the PMI off. The other thing to keep in mind, though, is that you're earning equity every year, so your property value is increasing. So you might want to take a look and see where that's at and either do a refi so that you can drop the PMI off, or bring it up with your lender like, hey, I'm actually at the 80%. Can you remove the PMI? Now, the only time PMI does not automatically drop off is when you have an FHA loan. Most FHA loans are 3.5% to 5.5% down, and the PMI stays attached to the loan for life. So that's one of the rare instances I will say refinance your loan. You heard me just say it a moment ago too. Like if you have to do it to get out of PMI, it makes sense, because reducing that payment, you're now saving $375 a month, but it's $375 a month that you were used to paying. So what are you going to do with that $375 a month? You're going to pay that on the principal of your mortgage in addition every single month. And if you're doing all these other things that I'm sharing with you, you're now probably up to over $1,000 a month extra against your mortgage. You will definitely have this paid off in 12 to 10 years. Okay, so our final strategy for 12 hacks to paying off your mortgage quickly is strategy number 12. Now, what is this strategy? Do not refinance your property every year or every time the bank reaches out. There's a time and a place to refi. There's a time and a place it makes sense. But every time you refi, the bank is charging you fees. So they're making $3,000 to $7,000. In addition to that, you're resetting the time frame of your property to be paid off. So you're resetting that 30-year cycle. But there are times, again, that it does make sense, like we just discussed, removing the PMI. Or let's say when you bought your property, you were at an interest rate of 8%, and then as we all have seen, interest rates dropped below 3%. You should have refied. And if you didn't refi then and you're still at anything over 6%, you should refinance right now. But the thing is, you need to apply all these other principles to pay it down quickly, okay? That said, when you get those statements, and this is something, I have a client who checks in with me every month. I love her to death. She gets a letter from a mortgage lender. They say, oh, I can save you X amount of money. She's like, oh my gosh, should I refinance? No. you have to realize when it comes to marketing, companies watch public record, they go scouring public record, they look, they say, oh, these people maybe would be interested in a refi, so let's tease them. You don't want to do that. You want to check in with your trusted professionals, your real estate agent, your lender that you worked with. You only want to do a refi when it makes the most sense. And guess what? There are what's called streamlined refis out there, which you won't have to come out of pocket to do the refi. So there are sometimes it makes sense, but do not refinance your property every year. Just like you shouldn't go and buy a new iPhone every year and spend $1,600 to $1,800 every year. Don't refinance your property every single time you get one of those letters, only when it really makes sense. Now, if you apply all 12 of these strategies, you are going to be winning and paying off your property quickly. And what is the purpose of paying off your property? That frees up cash. That's cash you can buy a next property, an investment property, money you can put into your pocket for retirement if this is a property that's actually an asset and earning you income. It's important that we become more fiscally responsible with our finances. There's so many people retiring in poverty today or retiring with only 5 to 10 years worth of money, and that runs out so quickly. So I hope these 12 hacks are really valuable to you. Apply them. Get back to me. Let me know what worked for you. And I have a couple giveaways for you. For those that do not have a budget, there's a link below. Click on that and I will send you a budget. And for those of you that are saying, hey, I want to make that extra payment. How do I figure this out? I need to play with it. Reach out to me. I will send you two things. I will send you a calculator that you can use on your own, and I will also get you set up on a monthly wealth updater that includes a calculator. Either way, you'll be covered. Thank you guys so much for watching this week. If you haven't subscribed to my YouTube channel yet, please click the subscribe button below and the bell for updates, and I'll see you next time.